Hey, what's up, everybody? It's Blake, Blake's RVA Loans, Arcus Lending, and obviously everybody has been paying attention to all the headlines that are out there about the Fed lowering rates, and I'm going to try to break this down as succinctly as I can in layman's terms. But obviously it's a big technical, so kind of bear with me. I want to go through like what the Fed actually did, and then I want to talk about what that does mean for kind of the mortgage bonds and the economy, and then I want to break it down to what it's actually going to do for rates. I was a finance major in college. I traded commodities and electricity and natural gas in my previous career, and I have resources out there, primarily a gentleman named Barry Habib that is probably the foremost kind of bond trader and bond expert in mortgage-backed securities. So let's just kind of break this down from the beginning. So the Federal Reserve lowered the discount points from 1% to 0%, which is the rate that the government will lend to banks overnight. So the federal government the Fed Reserve was supposed to meet on Tuesday and Wednesday of this week, and they put out an emergency meeting on Sunday, which makes me think that they're pretty panicked and pretty scared, and they had 100 basis points to give, and they gave it all up at one time. They didn't go down a quarter of a point or a half a point. They said, here it is, here's everything we have on this. Now, of course, they could go negative, but I really don't think that we're ever going to see negative federal funds or discount rates, because that's going to put a huge bind on our entire banking system, and we saw that with what's happened in Japan, and we don't want that here. So to further help out, what they've done is they've reinstituted quantitative easing, right? Quantitative easing was a fact that we saw in the 2008 and on, is where the government buys treasuries and mortgage-backed securities, and they hold them on their balance sheet. So they're actually the owners. So in 2018, they started reversing quantitative easing, and meaning that they were not going to continue purchasing, and as well as when bonds got paid off and you refinanced your house or you paid it off, you made a principal payment, they weren't reinvesting that principal back. So they're coming out and purchasing $700 billion of treasuries and mortgage-backed securities, right? $40 billion starting today. So it was $500 billion for treasuries and $200 billion for mortgage-backed securities, right? And when the government is there to buy bonds, the rates should go lower. Even more important, it was like one line in the notes that said they were going to stop the roll-off of mortgage-backed securities. So when you make your mortgage payment every month, or a home gets refinanced or paid off, that money, they were taking it and keeping the cash. Now they're going to be reinvesting that back in the market. So really the $200 billion in mortgage-backed securities that they are buying is probably closer to like $400 billion. The 200 new plus, say, estimated 200 of the roll-offs that they're going to stop. So in theory, we should see mortgage-backed securities and treasuries kind of in yields come down because of this. But I'm telling you, this is being done as a panic, and it's being done as a fear and liquidity concerns for our economy. You have to imagine a recession is coming. Our entire economy is based on consuming. If people are not out spending money at bars and at restaurants and traveling and tourism, it's going to grind to a halt. Like the people that are hourly employees, or your Uber driver, or the dog walker, or anybody that kind of has those trickle down effects, it's going to be tough. If people's kids aren't in school, who watches those people, right? And so I think we're going to see a recession coming. The other thing the federal government said is they have reduced thousands of banks' reserve requirements to zero, which is hugely important. So the Federal Reserve Act says that for every $100 that the bank receives in deposits, they can lend out 90% of that, and they keep 10%, right? Because when I give the bank money, that's a liability to them, and they owe me interest. So they're allowed to take 90% and reinvest that into loans so they can make money. Well, Dodd-Frank came out in 2012, and they put stricter covenants on that. There was a Collateralized Reserve Act, or whatever exactly it was called, that basically says that the bank has to also keep additional monies to pass stress tests. So they have reduced that to try to free up liquidity. We saw this in September of 2019. And in September of 2019, there was basically a run on the banks. meaning that a lot of people wanted liquidity out, they wanted their cash out, and Bank A didn't have enough, so they go to Bank B and they try to borrow money, and Bank B wasn't able to lend it to them because of reserve requirements. So that is out, and that's trying to stimulate the liquidity in the marketplace. Last week we saw mortgage bonds, stock markets, treasuries, and gold, and everything sell off, and that's a very unusual thing. And so let me tell you why that happens. People greed. The market is fed by greed and by fear, and so when things are going really, really well, people get greedy. And what that means is if I have $1,000 and I want to buy stocks, and I'm making 20% on that $1,000, I could also go borrow money on margin to buy more stocks. I could borrow another $1,000 at a few percent interest rate, and then I could have $2,000 in the market, make it 20%, and I'm catching that spread. When the stock market goes down precipitously like it does, people get margin calls. Whether it's you and me and the individual investor, or big banks, investment firms, hedge funds, they're doing the same thing. So if you have purchased stock that was cost you $10,000 and now it's only worth $7,000, and half of it's on margin, and you sell it, that's only $3,500. So you know what you sell? You sell the things you can sell that have value, which are treasuries, mortgages, gold. So that's what happened last week. As people were trying to raise cash and liquidity from margin, we saw a sell-off in the mortgages and treasuries and gold and the stock market. And that's a very dire and unique place that we don't want to be in. So that's kind of why the Federal Reserve has come in, not only lowering the rates of which banks can lend to each other and they can lend back to the government to ease up liquidity. They've reduced the amount of reserves banks need to ease up liquidity. And they're also trying to kind of bring some order to the bond market by sapping up that liquidity and demand by them purchasing, right? So it's like all out. The Federal Reserve is doing everything they can. So in theory, when you buy bonds, when the government buys bonds, rates go down. But is this actually going to happen? And that's a huge concern. And we have to understand, because rates go to zero, mortgage rates do not go to zero. Interest rates last week on mortgages were up 0.5 to 0.75% because people were selling bonds to make up liquidity. The previous week, mortgage rates also were up, and that was because there's capacity issues in the mortgage banking system. There's about $11 trillion of mortgages outstanding as a national, or as a notional value. That's 11 trillion with a T, trillion. All right. Probably about half, conservatively, half of those are eligible to be refinanced at significant savings to the consumer. That's $5.5 trillion worth of mortgages that we could probably refinance. In a good year, the mortgage banking system as a whole does about $3 trillion worth of mortgages. Half of those are purchases, so 1.5 trillion in purchases and 1.5 trillion in refinances equals 3 trillion in a year. And now we have another 5 trillion trying to come in. It's not able to be done in 1 month's time. A good month is 250 billion in mortgages. How can you do 5 trillion in a month? So there's massive capacity issues on mortgage banking systems. So you can't get through all these mortgages and these applications. So rates are not going to be able to fall down as precipitously as they should. And this is not mortgage lenders gouging, which you might think, right? This is not a gouging of a system, because you have to think about what the company is going through. The company is having mortgage companies are having a lot of liquidity concerns for a number of reasons. One, when you lock an interest rate, and I lock you at 3.5%, and we're closing in 60 days, there's no real thing as a lock. That is a company has invented a locking mechanism that allows people to have that sense of security. They've locked in their payment. And what they're doing is they are hedging out the lock through financial options to guarantee that they're making that same margin. So if I lock you at 3.5 and rates go to 4%, the bank doesn't realize that profit until they sell the mortgage. So if rates go from 3.5 to 4%, but you, the consumer, still get 3.5%, the bank when they go to sell that mortgage, they are going to owe money because rates have gone up. But what they do is they have hedges in place so that even though it's more expensive when they go to sell the mortgage, their hedge has increased in value, so they're made whole. So conversely, when rates go down, the bank knows they're going to make money at a higher lock, but they're renegotiating locks because consumers are demanding them, or the consumer is going to another bank to get a lower rate, and that money is only realized when they sell it, but there's margin calls on those options that need to be paid immediately as the hedge is not becoming profitable, it's becoming severely unprofitable. So you have mortgage companies that are bleeding cash out because their hedges are way upside down. Furthermore, they have payroll just running around the clock trying to get all these applications filled, underwriters, closers, QA. There's people working around the clock, and we know how that feeds up with overtime. So I really just think that I'm a little bit of like, we need to be cautious. There is a recession coming. I think that we will see interest rates lower in the future. I think that hopefully this coronavirus, I've read that it should peak in about 1 month's time, but I think the only way that's really going to happen is there's going to have to be some mandated level of self-quarantine. I mean, I was out in Richmond this weekend, and people are out all over the place, out there at bars and St. Patrick's Day and whatnot, and people aren't going to stay home unless it's mandated. And so if you're home and you're not spending any money, how does that trickle down for the economics in a recession? But lenders are not going to be able to just go and take a 3.5% rate and change it to 2.5% overnight, because they are bleeding money on margin calls, they are bleeding money on overtime and payroll. There's a lot of uncertainty. Additionally, when mortgages get paid out early, everybody's had a mortgage and it gets sold to the next person, right? When it gets sold to the next person, there's a covenant that mortgage needs to be serviced for a period of time, and if it's not covered in a period of time, then the person who sold it owes that money back. So as refinances come in the door, those covenants in that time period is not going to happen. So I just wanted to kind of break this down on a number of levels. The Federal Reserve lowering rates has nothing to do with mortgage bonds. That is purely to stimulate the liquidity for banks so that there's not a run on a bank and they can survive. Quantitative easing, which is the federal government buying mortgages and buying treasuries, should improve mortgage bonds over time. That is a huge stimulus. But there's a massive amount of capacity issues. I relate it to the Popeye's chicken sandwich craze, right? Everybody wanted a chicken sandwich from Popeye's. There's not enough to be had. Or at Christmas time when the new iPhone comes out and there's a line wrapped around every single iPhone store in America, does it go on sale? And this is not price gouging. There's a lot of economics at play behind the scenes. So that's kind of my two cents on it. I think that if you guys, people are looking to refinance, you have to take a good rate, you lock in your savings, and we have to anticipate it's going to take a longer period of time. If you're purchasing a home or selling a home, you have to anticipate it's going to take a longer period of time. There are more mortgages getting applied for at any period of time that we've really seen. I saw that from the week ending March 2nd to March 6th, refinance applications were up 500% over year, so that's 5 times, and the most number in a week since November of 2008, right? There's not enough capacity in the system to do this. There are just not enough supply to meet demand. So therefore, rates are great. They could get lower, but you're not seeing this nosedive of rates. This is a very, very, very complex business that we're in. You have to get underwritten, you have to get appraisal, you have to get verification of appointments. And what I think, my personal opinion, is that you're going to see a little bit of a halt. Because what if the counties are closed and you can't get title search done? Or what if people are not working from home and you can't get verification of appointments? Or what about if appraisers are booked up because of all the refinances and they can't get to it? I think you're going to see a slowdown in the turn times of mortgages. We can't do $5 trillion of mortgages in 30 days. That's like 2,000% as of normal. So that's kind of my 2 cents on it. Obviously, this is just my opinion, so this is not reflective of anybody else. But what I need you guys to know is that the Federal Reserve lowering rates does not mean we have 0% interest rates. It doesn't mean it happens overnight. It does not mean that we can refinance the whole entire country in 30 days. And there's a lot of other factors at play. And I personally think that we're going to see a lot of trickle-down recessionary environment right now, because our whole entire economy is based on consumer spending. And if we're not out spending money, it trickles down very, very, very fast. And if there's a population of people that have money in savings and they can ride the wave and they can be out of pay and they can stay home with their kids, there's a very, very significant amount of our population and people that don't have that luxury. They don't have paid time off. They don't have emergency savings. So what happens if people start missing mortgage payments, start missing car payments, don't have that cash flow? So I hate to be dire. I don't want to be like Humpty Dumpty's falling off the wall, but I just see it being a little bit more than what people think it's going to be. This is not a blizzard for a couple weeks. It's not a hurricane coming through. That we have a very, very, very highly infectious, transmissible virus that is it's really real, and I think we're in kind of dire straits. So all of my customers out there, I promise I'm getting to everybody. If everybody wants to talk about this, I want to get this video out to kind of explain it, because rates hit all-time low and then they went up. First week because of capacity, last week because people are selling mortgage bonds that generate cash. We should see a correction and get lower, but I don't know what the low is. I don't know how you tell when you hit the low. So we should see a leveling back off. We should see some rates get better, but it is not tick for tack. Hey, government lowers rates in a pin swoop in a conference to 0%, and mortgage bonds react the same. It is completely different. There is a laggard. There's 1,000 things behind the scenes that take that into consideration. So anyway, that's kind of a long ramble. I know it's probably very technical. If you guys have any questions, let me know. I'll probably be burning it on both sides this week, but like everybody else, you have trips planned, those are canceled, right? And so I'm here to work. Let me know what you guys think, and I'll be here to answer any questions. Thanks. Bye.